All right, well, hi everyone. Great to be here and great to see a lot of old friends here today, and so a pleasure to be here to talk to you and great to see the turnout. What I'm going to talk about today really is to explore this idea of a natural capital asset class. What is the transition that's occurring from our conventional forestry and agricultural investment into this new concept? Give some examples of some of the investment strategies that we're pursuing, and then look at some of the opportunities and implications for investors more widely. And I'll probably emphasize more on the forestry than the agriculture side because that's really my background. Okay, so just to quickly introduce the company, New Forest is an investment management business. I founded it in 2005, so we've been going for about 18 years now. We manage around $7.5 billion US dollars in assets across about 1.25 million hectares. We've built that brick by brick over the years, and most of our client base is large institutional investors, pension funds, insurance, reinsurance companies, sovereign wealth, and some development finance institutions. We have set the company up with regional investment strategies with teams in Australia, New Zealand, Southeast Asia, North America, and Africa. And really from the start, I guess, in founding this business, I really wanted to look at investment strategies that demonstrated how forestry could be part of the transition to a sustainable society. And in some ways, it's taken a long time for the world to catch up, but I think we're there now. And it's really the challenge now to scale up that capital. So the conventional forestry and to some degree agricultural asset class is based on some of the unique sort of financial characteristics of forests and agriculture. In the case of forestry, we have this unusual characteristic of a capital appreciating asset. So as trees grow, they become larger, they become more valuable. So you get that inherent capital appreciation in the underlying assets. And then when you cut trees and sell them, you get income. So you have some kind of optionality. The total return is the sum of the capital appreciation plus the income. Because a lot of the return comes from biological growth, there's no real inherent correlation with other asset classes, and so investors have found that very useful in terms of portfolio construction. But forestry and agriculture have been positively correlated with inflation. So again, in the current circumstance, that is another benefit of having forestry. And lastly, the volatility has tended to be low relative to the returns. And to some degree, that's because the volatility of the underlying asset value is lower than the volatility of the markets that the forests are exposed to, because you don't have a maturity point in forests. So you can cut them when you can increase and decrease your harvest rate depending on market conditions. So, we've been operating for 18 years, and if you look at our consolidated portfolio, we've never had a year of negative returns. And I think that really reflects on the value of forestry as an asset class in the traditional portfolio allocation policy. But times are changing, and investment imperatives and investment strategy are also changing. All major economies now have taken on net zero emission commitments. Most have taken on interim 2030 commitments, which is driving a focus on near-term action. Nature conservation, particularly with the Montreal COP last year, is rising alongside climate as a huge systemic risk issue for investors. And so you've got investors with trillions or tens of trillions of dollars of capital who are making commitments around decarbonization, nature-positive investment strategies, and that's leading to this concept of a natural capital asset class where we can deliver those positive outcomes from our investment strategies. There's two, I think, big areas that we can deliver as a natural capital asset class. The first is, promoting the role of forest, agriculture, land use in reducing emissions and contributing to biodiversity conservation embedded in investment strategy. And the second is looking at the role of the forestry and agriculture sectors in a transition to a circular bioeconomy where we're increasingly using sustainable, renewable, naturally decomposable materials in our society, moving away from kind of a linear use and waste stream kind of a model to something where we'll have more circularity in the use of these products. So today, I guess what I'm going to talk about is these three themes: circularity, optionality, granularity, and I'll come back to those and explain what they mean in terms of investment context. But it does lead to opportunities to transform forestry and agriculture into this natural capital approach. So the circular bioeconomy is driven by feedstock from biomass production. And when you look at the world today, we produce about 19 billion tons of agricultural products, about 4 billion tons of forestry products, a little bit of fisheries. That creates about 17 billion tons of food and animal feed going into our human food supply chain, and about 4 billion tons of products coming from both timber, fiber, biomass, and then about 2 billion tons of energy. And when we look at that, you can compare that with 4 billion tons of concrete, 2 billion tons of steel, 400 million tons of plastics. The objective is potentially to replace a lot of those high embodied energy or non-recyclable materials with biomass-based or forestry-based materials. And you can see in society today rising demand for cellulosic fabrics to replace polyester, bio-based packaging to replace plastics, new engineered wood materials that can create multi-story built environment out of low carbon wood building materials versus concrete and steel, biochemicals, bioplastics, bioenergy fuels. So there's a whole myriad of opportunities if we can expand the supply of sustainable feedstock. And I think that's one of the big continuing areas that, as Mike, I think, said, we still need to keep producing wood and biomass because that will be part of the solution. We have, in our case, invested in vertically integrating. So we have operated forests and processing, and it's really interesting where in Australia we had the two big forestry plantations in South Australia and Tasmania. We bought the sawmills that were the primary breakdown or producers of timber from those mills, and now we're adding secondary processing. So in the case of our South Australian mill, we're adding a cross-laminated timber, glue-laminated timber plant that's the size of 4 football fields. And that will be producing these 16-meter-long panels with all the services put in and then taken in and craned into place. In Tasmania, we've got a system now where we take a lot of the plastic waste, we grind that up with the sawmill wood waste, heat that up and extrude it into a termite-resistant wood-plastic hybrid decking product that's potentially continually recyclable into other products. We're looking at finger jointing the low-value timber into high-value timber. From there, we may look at biochar, stranded lumber, a whole range of products. It almost becomes like a processing ecosystem that can, derive multiple products for society out of the tree. So the other second big theme really in terms of this natural capital transition is around option value. And I often use the analogy of infrastructure, who figured this out like 25 years ago, that if you bought an airport and you bought it at the net present value of the landing fees, then suddenly people realized, gee, we can add a shopping mall, we can add a convention center, a hotel, a parking lot, and all of a sudden the airport became worth 3 or 4 times the value because of all of that embedded option value. And that's what's happening in forestry and agriculture. We're now seeing food, fiber, timber, climate finance, biodiversity finance, solar farms, wind farms, water rights, green infrastructure payments. All these things swirl around now the core asset and can be integrated into the return profile. And that can increase the income, it can increase the asset value, and it can diversify the market exposures and reduce volatility. And that's really what I'll talk about today is how we can think about that as a way to drive sustainability, but also to drive great returns for the investors. So natural climate solutions, I think a couple of people have already talked about this. In fact, Justin, kicking off, talked about this. But whether it's 25 or 30 or 35% of the solution, forest and land use are the most underinvested part of the decarbonization transition that we have to go through. And there's three legs here of what we can do in terms of contributing to the decarbonization through land use. The first is protecting intact ecosystems that are still there. In other words, stop deforesting areas. The second is to better manage working lands to reduce emissions and to increase removals. And then the third is to restore degraded land back into either production systems or natural ecosystems for conservation. Across those three legs, you can see about 10 billion tons per annum of potential emission reductions and removals. That's only going to happen with a huge amount of capital deployment. And so, the job is to get these investment strategies at scale where they can actually make a difference. But in a lot of these landscapes, the climate-related funding could well rival the value of production from the forestry and agriculture. It's that sort of a scale. And that is really changing the way, as investors, we think about what the return profile will be from different investments. So as a company, we operate across multiple carbon price signals now. We have the California AB 32 market. We have done maybe 24 projects in that market, a lot of them with Native American communities. It's largely driven by improved forest management, extending forestry rotations, putting marginal stands into conservation management. Trades at around $20 a ton. It's been rising at sort of 6% per annum. So the California market has an underlying price floor of 5% plus inflation per annum. So that's a pretty good return in its own, just holding those instruments as allowances. The New Zealand system is trading around $30 a ton. It's driven really a lot of reforestation of marginal land, and I'll come back to that in a minute in terms of lessons learned. The Australian Emission Reduction Fund and the Safeguard Mechanism, they drive forestry investment in reforestation and also extending from short rotation to long rotation forestry crops. A lot of that's underwritten by the Australian government as a buyer, but then now increasingly the private sector is having to intervene and participate in that market, which has really lifted the price quite a bit. And then we have the whole kind of voluntary market, which has been a little volatile in the last couple of years, as we've heard from previous speakers. There's been, continuing debate about the quality of some projects and so on, but there is a lot of effort to try and improve that market, make it more investable, help it to scale, so we can also see the price coming up, so it will actually help support positive land use change. So how does carbon pricing affect investment? We have a lot of our forestry assets now are exposed to a carbon price signal, so whether you like it or not, you're in that game. And the first thing I would say, looking at investment committee papers, some of them, like half the papers now about the carbon position, what's been sold, what's been leased, what's the alternatives in terms of growing the forest and carbon and timber values. There's a debate about what's the discount rate for timber cash flows versus carbon cash flows. You can see that upper price signal of the ACCU, the Australian Carbon Unit price. It went to a peak in the 50s, and then the Australian government just decided to release all of its supply into the market and crash the price down. And so we definitely use a higher discount rate for carbon prices at the moment than we do for timber or agriculture. Other lessons learned, in New Zealand, the price of carbon went up to 90 New Zealand dollars a ton. Very quickly got capitalized into bare land prices. So, rural sheep grazing properties that were worth $4,000 a ton became worth $17,000 a ton because it was capitalizing the net present value of the future carbon revenues. We see like an economic margin phenomenon again where at a certain price of carbon, the next hectare flips into being a higher value in forestry. And so as the price rises, you just start to see more and more areas that, make a higher return from being reforested. But then the price gets even higher. You start to flip again out of rotational forestry into permanent forest crops because the carbon price is now higher than the stumpage value of the timber. So you get these really interesting economic tipping points that occur as the carbon price changes. And the other thing is that all of these markets to date have had different rule sets, so that changes how investment strategy is going to be affected, and you have to understand those rules and their implications. The third, leg of my message today is around analytical developments and the analytical horsepower that's being applied now into what I would call granularity, a geospatially modeling different phenomena on the landscape, whether it's the presence of unrealized carbon value in landscapes. You can write rules around different data layers that will allow you to actually show heat maps of where there's unrealized carbon value that you can invest in. You can look at areas. There's a company in Melbourne that looks at the annual estimate of Australia's wheat crop, and it very quickly became apparent which farms were performing well, which farms were underperforming, which parts of farms weren't making money, and you can just start to target investment much better than you could if you're just buying whole farms and trying to plant them with trees or grow wheat. You start to see this granularity or better allocation to extract more value out of the land and the landscape. And you can ask questions like, if I took the state of Minnesota and looked at land price, hybrid poplar productivity, and then a toggle on carbon price, it would start to quickly show you where you could invest potentially at different carbon prices to undertake reforestation. So these kind of tools linked with the option value are creating quite complex and dynamic investment strategies, but which will generate much higher return and increase the value of these assets substantially. So an example, in our U.S. business, we have the Forest Climate Solutions Fund. We developed this proprietary geospatial modeling tool that could allow us to actually show where there was California CCOs in the landscape that were unrealized, and then we basically go in and invest in those areas. We use a discounted cash flow valuation model to price the forestry, and then we re-optimize that to timber and carbon value, and we can add 200 to 400 basis points to the return. So it's just a strategy that's based on intellectual property, really. So where does this lead us to, I guess, as investors? The first thing that strikes me is that, we had silos of forestry and agriculture and conservation finance. That's increasingly suboptimal as a way to think about investment. We need to look at investing in landscapes and then allocating those landscapes between these different uses. The broadening sources of option value are going to give us a lot more capacity to respond to multiple market signals and be much more able to extract value from assets. We may have quite variegated access to land, so we may have core freehold areas, we may have land leasing models, we might have partnerships with rural communities and indigenous people, and it may lead to different fund structures, so things like open-ended versus closed-ended funds, embedded offtake contracts, someone was saying, to reduce risk of certain volatile cash flows, blended finance structures, renewable development, wind farms, solar farms, so on land with third-party developers. Here's another example is our Australia-New Zealand fund. We're calling it a landscape fund this time around. And, here we can invest across forestry, agriculture, conservation finance, circular bioeconomy processing options. We can have an option for rolling extensions of the fund. And we'll have higher expected returns because it has so much optionality that we can exploit in that vehicle. And, this is sort of the theoretical before and after that we can look at in these type of landscapes where we can create much broader sources of return, a higher total economic envelope, and much more resilience to climate and other potential issues over time. Our Asian fund, again, kind of an innovation in terms of having used a blended finance structure where we have a Class A, which is conventional investors looking for a conventional risk-adjusted return, and then we have a Class B who are, we call it an impact tranche. We put all the money together, but 50% of what comes from the impact tranche goes into a menu of high impact activities around biodiversity conservation, climate mitigation and adaptation, and community development. And there's then a differentiated waterfall from the fund with both of them getting a kind of a 2% preferred return, and then the conventional investors get a 10% preferred return, and then it's pari passu above that. That starts to really allow different types of capital with different motivations to come together and work in a synergistic fashion. And most recently, we launched the African Forestry Impact Platform. That's with partners, British International Investment, Wharf Fund, and FinFund. The idea there is to consolidate some of the smaller plantation forestry businesses into a scale, long-term operating platform. And then once you have that sort of perpetual forestry in the center, you can start to layer on the conservation, restoration, community forestry, and that's why we call it a platform as opposed to a fund. And we've just made our first investment there in a company called Green Resources, which operates across Uganda, Tanzania, and northern Mozambique, and we're hoping to raise that from now the initial 200 up to about 500 million to get a scale, open-ended investment vehicle. So when you think about that, the scale of option value, the fact that this allows the forestry and agriculture and natural capital asset class to expand more widely, more investment opportunities become available. We can see the asset class going from 250 or 300 billion today, maybe towards something like $1 trillion in the next 10 or 20 years. And I think that's really the opportunity for all of us, is to build a bigger pie, if you will, that is going to be driving the sustainability transition and bring the higher scale of capital because of the kind of exciting investment opportunities that are ahead of us. So we'll just finish by saying that you can see how forestry, agriculture, conservation finance are sort of morphing together. The idea of option value is driving a lot more creativity in investment strategy and investment opportunities. There's also risks, of course, relating to climate change itself, but those risks can be managed in terms of how we set up these forests, the use of insurance products and other management regimes. But if we get the transition right, I think we can make a substantial contribution to climate change, conservation of biodiversity, rural community benefits, and transitions in the built environment. Thank you very much.
We've got a couple of minutes. David, do you want to take some questions from the audience?
Sure.
Yeah.
Thanks. Hi, David. I'm John from Geotree. Great presentation. I really enjoyed the framework of options, I think, in terms of the asset investment case. And I think, with 50 years of Black-Scholes now, I think the anniversary this year, they'll probably be really chuffed to see you applying such a framework to real asset investment. My question is with respect to agriculture. That's been a bit of a difficult area for us to really scale in terms of carbon so far, especially when you compare it to forestry. So just wanted to pick your brain in terms of your thoughts for the low-hanging fruit, so to speak, in terms of agriculture investment opportunities, if you thought of a few top potential opportunities you wanted to discuss.
Yeah. So last year we bought 100,000 hectares of grain farms from Macquarie Bank, and we're looking at that now in terms of what is the natural capital play associated with that. Firstly, there's areas that are being farmed that aren't really productive, and so those areas can be put back under revegetation for a carbon value. I think we're looking at regenerative agriculture and how that can lead to long-term soil carbon changes. We're looking at, because now we've got the forests, the sawmills, and the farmland, maybe we can take the sawmill waste, make biochar, till that into the agricultural soils and have like a carbon play, but also improve, water holding capacity and nutrient exchange capacity. So I think there's a lot of opportunities. We're just sort of in the early days of exploring, how that will work economically.
Hi, my name is Chitty Oti Obihara, and like the former speaker, my background is also in derivatives pricing. So rather than just celebrating black shoals, I want to draw your attention to Farmer 1990, efficient market hypothesis. If we think in a bit more detail about your excellent heat map tool that you mentioned for identifying different underutilized carbon assets, are there issues of scale and liquidity that matter? Are there ways of being clearer about what kinds of opportunities are realistic for exploitation, and what sort of gaps in return or value do you look for before you can act on those? Thanks very much.
So, look, these heat mapping tools and geospatial analysis have multiple different ways that you can use them. You can use them to guide investment strategy. You can use them to guide operational management over time. We have, as an example, a program in Tasmania we call Active Acre, and we work with the rural farmers, and we look at their lands, and often the farmer might have, a 400-hectare property, and 100 hectares of that might be steep ground or areas along riparian zones, or areas that aren't really producing a lot of value, and we say we can come in and take that piece of your farm and reforest it either with commercial timber plantations or just with straight revegetation, and we'll pay you a fixed income for the use of that land. So in a sense, then we take the long-term risk, the 30-year risk, if you will, with institutional capital, and the farmer gets that converted into a fixed income, and it's all incremental revenue to the farmer. So you start to see that resegmentation of land use to basically create more value than what has been done in the past, where people have just taken whole farms and used them for a single purpose.
Thank you. Last question.
Paul Chatterton, Landscape Finance Lab. David, congratulations. I mean, you're a real lighthouse for us all. I think the development of the portfolio, but also the complexity that you're now starting to get into. My question is about landscapes, of course. I'm interested to see that you're engaging in that, and I'm keen to hear what lessons you're learning and how you're rolling that out.
Yeah, it differs a little bit geography by geography. So, you have places in the world, you take the U.S., Iowa grows corn and Washington grows Douglas fir, and you can't grow, you can't float those back and forth. But in Australia and in New Zealand, certainly landscapes are completely fluid in terms of the opportunity to deliver different ecological services and goods. And so as those price signals evolve, the landscape will evolve to match, what the price signals are driving. So we're certainly finding in Australia that some forestry areas that were planted up on farmland were probably inappropriate, so they're probably going back into farming, but then farming is starting to get much more, as I say, granular allocation of land to increase returns from some of the new carbon markets that we have in both Australia and New Zealand. I would say there's also a lesson learned on the downside that New Zealand, where the carbon price went up so fast, all kinds of foreign buyers came in and just started buying up farmland and planting it up with permanent trees, and there was a real backlash from the community that they weren't engaged in how that transition was happening. So you've got to also make sure that you've got a strong engagement with communities if you're going to have successful land use change and a sustainability transition. anyway, I might leave it there.
Perfect. Thank
Okay.
you.